And welcome to ETF Edge. It's your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Markets are bouncing back today after a rough Friday. Better than expected U.S. manufacturing data also helping the markets today. Joining us, Jeff Kilburg of KKM Financial. Jeremy Schwartz, he's the global head of research at WisdomTree Edge. Professor Jeremy Siegel, senior investment advisor to WisdomTree, and a professor at the Wharton School of Finance. But you all knew that. Professor, let me start with you. A quick thought on the coronavirus and where we stand. We're already seeing some declines in first quarter earnings estimates for some of these global cyclical sectors like materials, industrials, energy, hotels, for example. What has to happen with this virus to stabilize the market, in your opinion?
Well, Bob, we know in the short run, fear and greed, momentum players, they dominate the market. Sometimes greater than reality. Really, how serious is the coronavirus? There's a lot of debate. At this point, I look at death rates and say it's not much different from other influenza, but others say that it could get worse. So, there's been a huge reaction, the shutdown in travel, and obviously that affects entertainment and airlines, and that fear can keep on generating, and then who knows? In 2 or 3 weeks, we can say it's relatively contained, death rates are low, not much more than others, and then we'll get a relief rally from that. But it's impossible to tell how long that will take.
Yeah, the good news is the death rate seems to be low, but the incubation period may be long, so we may have a lot of people that are being affected. You have pointed out before that the market leaders this year are defensive names once again. So utilities and long-term treasury bond ETFs are leading. Both of them are up nearly 7% of the year. That's outperforming everything else. But will that not change if the coronavirus suddenly becomes less of an issue? They're not going to be buying defensive stocks necessarily, are they?
They will not be buying defensive stocks or treasuries hand over fist, Bob. But nonetheless, you are seeing attracting assets to these two sectors due to the reason we don't have clarity. The lack of clarity, that's corrosive. And what is that doing? It's attracting assets coming in. Look at the 10-year note. We're in 125th day in a row, being our 2%. It's trading 153 right now. But on the flip side, the utilities, it's interesting to see. Yes, we have seen a big boost due to the coronavirus. But if you go back 3 years, Bob, it's been 3 years neck and neck to the S&P 500. So I think this search for yield, this global search for yield persists.
Yeah, I think that's the important thing. This is, even if you look at relative strength indexes, utilities held up all last year. So you can't just say, oh, this came out of nowhere and utilities have been suddenly outperforming. You're very big, Jeremy, of course, on yields. And you've been pointing out, too, that a better way to play this, frankly, given utilities are so darn expensive right now, maybe high yield, maybe yield stocks at this point.
Usually utilities have this above average yield characteristic. And when we look at the average dividend paying stock, we have a total dividend index, 1,500 dividend paying stocks. It's got the same yield as utilities, sort of 3% average yield, but instead of being share issuance, there's 2% net buybacks. They're 3 or 4 PE multiple points lower than utilities. So I'd rather get the total diversification, the same yield, but they're doing buybacks. So I think that's a better play, the average dividend paying stock, than utilities.
And you're very much on top of this over at WisdomTree. I want to move on and talk about the fast-moving ETF business in general. Now, last Thursday, WisdomTree launched 2 new model portfolios designed to challenge that traditional 60-40 stock bond approach. This is the Segal WisdomTree Global Equity Model Portfolio. It's a mouthful. And the Segal WisdomTree Longevity Model Portfolio, developed in collaboration with our star here, Professor Jeremy Siegel of the Wharton School of Finance. Jeremy Siegel, you're trying to address 2 persistent issues, lower interest rates and lower U.S. equity returns. And you say the traditional 60-40 stock bond portfolio isn't going to cut it. Can you explain why and what's behind this?
Well, that's certainly true, Bob. With yields at the levels they are, and in my belief, and I've been saying this, as you know, on CNBC a long time, this environment of low interest rates is not going to change. How is 1.5%, which is what the 10-year is right now, going to give you enough income? The dividend yield is higher on the S&P 500. Our dividend-weighted products are much higher, 2.5, 3, and some are even more, and they give higher return. We believe that the old 60-40 model just won't be able to cut it anymore. And that's why we recommend 75-25 as the equity fixed income allocation would be the best way for those approaching retirement to establish their assets to get enough income and gain so they can maintain spending through retirement.
And you believe this is a very important part of the story. I think lower interest rates are here to stay. They're not some phenomenon the last few years. That this is going to be, this is going to be around for a long time. If that's the case, stocks are definitely, in many cases, a lot more attractive.
Yeah, absolutely. It's not, one thing I have to remember, it is not just the central banks that are setting interest rates down. It is powerful demographic factors, aging of the population, longer life expectancy, risk aversion, slower growth. All these factors are going to keep these interest rates in these levels very long, and you cannot survive on a 1.5% nominal interest rate. Look at the TIPS yields. The real interest rates are negative now. So it cannot maintain spending streams at all. Dividends on stocks are going to be the new bond in terms of thinking about retirement.
And Jeff and Jeremy, we've talked about this in the past. I get emails from the viewers, essentially what Professor Siegel was saying. It's the Tina story. There is no alternative. What do you want from me, Bob? I'm going to buy 1.6% 10-year Treasury yields. The S&P is yielding 2%. It does make some sense. If Professor Siegel is right, interest rates lower for longer, stocks are more attractive.
It does, and kudos to Professor Siegel and WisdomTree for coming out with this, but this really challenges Harry Markowitz. Remember Harry Markowitz back in 1952? He created the modern portfolio theory. So I think we do have to shake it up due to the interest rate environment, Bob, and right now this search for yield, I don't think it goes any way. Last year alone, of the 67 global central bankers, 50 of them ease. So I think when you continue to see this accommodative, easy mode, you have to find additional yield somewhere else.
Can you tell us a little bit more, Jeremy Schwartz, what's in these model portfolios? Presumably you're going to turn them into ETFs, is that right? I mean, where's this going?
I mean, right now we're making these models available on the major model platforms. We announced from the TD Ameritrade conference last week, the TD Model Market Center is one of the big platforms where all these model portfolios are available. And the idea is really marrying Siegel's two big books. So Stocks for Long Run was all about stocks having short-term volatility, but actually less long-term volatility compared to bonds, and that's upping your equity allocation. The second book that I helped him on a lot was The Future for Investors, which married high dividends, low PE investing, what we call the DIV directives, and that's what's in these models. There's emphasis on high dividend stocks, low PE valuation stocks, multi-factor diversification, because you're taking equity risk, you need to lower the risk within the portfolios, and there was also a heavy emphasis on being global and international, having a decent amount of emerging markets.
If we want to know more about it, we can't buy an ETF though, it doesn't exist yet, right?
You got to go to the website, wisdomtree.com, and there's a advisor portal where you can get the allocations to these models, or for sure advisors on the TD Model Center.
Good. I want to move on here to hit a few hot topics that we heard about at last week's Inside ETF conference. First, the continuation of the fee wars. Now, we're in a race to zero for index funds, but fees are coming down right across the board. Jeremy Schwartz, what does it mean for a firm like WisdomTree? There's fee compression everywhere. That's got to be an issue for you as well.
When we started our first 20 ETFs in 2006, it was already low. I mean, the beta ETFs were 9 basis points when you started. You have to have differentiation. You have to add value. You just can't be a beta solution, right? So that's WisdomTree calls it modern alpha, trying to create systematic, rules-based, value-added portfolios. But
look, I would just point out they're putting up your stock here. I mean, it's been under pressure for over a year now. I can't help but think that part of that is due to the fee issues for you as well. I mean, that's got to be a major problem.
We had two sort of blockbuster funds in 2013, 2014 that raised a ton of money, and then they've been under pressure. This Currency Hedge International with Japan and Europe. We still believe very much in the broad case and actually the developed international broad solutions are actually starting to see a lot of more interest from us. But that's what's going on really, is as you had a huge inflows, it's been sort of bleeding out, but it's, we think it's stabilizing. It was the least amount of outflows you'd say, in 5 years last quarter.
Yeah, and as the ad says with Professor Segal, actively managed ETFs are the future, and of course you're seeing that too, where there's a whole movement here to bring non-transparent active management into the ETF space this year.
We've been very public that we're more about index-based and transparent active than non-transparent.
Go ahead, Professor, you wanted to say something?
Yeah, I just wanted to mention, Bob, you're absolutely right. The downward pressure on expenses, and that's why in these portfolios we paid a lot of attention to minimizing our expenses. Really a very low expense ratio for these Segal portfolios, and that was kept in mind because of exactly those competitive pressures that we all face today.
Okay, let's move on here and address some thematic ETFs and ESG subsector of thematic ETFs. Cannabis was hot last year and then it fizzled. Now it's trying to come back again. What's going to be the hot thematic ETFs this year? Jeff, I know this is a tough pick. I know it's sort of like a popularity contest, but everybody likes it. Let's just isolate ESG for a minute. And anything out there that's really going to catch the public's attention this year?
Well, certainly people are still reeling from cannabis last year, and it did go up in smoke. But this year, technology continues to be the #1 sector, but that's a little bit boring. So I want to go back to the fact we talk about this defensive component, right? And when you're looking for in the 128th month of this historic bull cycle, I think we have to realize that Microsoft and Apple can contribute another 15% to last year's 30% gain in the S&P 500. So I think you have to stick with value. I know value is a little bit boring right now, but I think you have to understand some of these ETFs can give you a broad swath exposure, but sticking with technology, sticking with utilities until the relative strength diminishes, I think that's where you want to be in 2020. These themes will persist from 2019, they'll carry over to 2020.
Jeremy Schwartz, he mentioned tech is boring, but I see continuing interest on the part of our viewers on exponential technology type ETFs, in robotics, in AI, in genetics, disruptive, that is going to go right across the board and influencing. Like artificial intelligence is really going to influence virtually every industry that's out there. It's hardly even an investable area since everyone is going to use it, but there's continuing interest in disruptive technologies as an investment.
We see that all the time, and we are ourselves investing in some of these thematics like a cloud computing and things like modern tech platforms. But I think one of our big themes for 2020 is this rotation back to value, and going back to Professor Siegel's work on, you got to be careful what you pay for these things, and people get overly excited. They often overpay for growth. We called it the growth trap in the future for investors, and so that's the return for 2020.
I think Jeremy brings up a great point. In owning sectors that continue to reveal strength and staying away from the sectors that are not revealing strength. Oil, in specific, oil had a disastrous year in 2019, and it's down 11%, the worst sector in the S&P 500 this year. So stay with what's working, stay away from what's not.
Professor, let me get your thoughts on ESG, environmental, social, and governance. I've been saying for a year and a half that it was a little bit of a joke 2 years ago in the investment community because everyone said, well, of course we're in favor of ESG. Who isn't? But where's the money? Nobody was putting any real money in. In the middle of last year, that started to change, and we started to see significant inflows. There was a big debate at this ETF conference last week. Exactly what is ESG? My ESG is not your ESG, and the industry really has to tighten up the standards a little bit. Can you give us your thoughts on ESG and where it fits in anybody's portfolio?
Well, you're right. I mean, there's not a big bright switch. I am or I am not ESG. Just like there wasn't a bright switch, are you a value stock or not, right? I mean, some will be put in those categories, other will not. One has to also be very careful. I mean, I've seen some historical studies about outperformance of some of these ESG stocks historically, but remember, if everyone's moving to them, that causes outperformance, but if it leads to too high valuation, it leads to long-term underperformance. Right. So you got to be really careful of that. I'm very wary of saying, oh, in the past, these have done well, and they've come up recently, people are buying them, and then saying, oh, that means it's going to do well in the future. I also want to mention something about value and growth. During this pressured part on the coronavirus, growth is still outperforming. The FANG stocks are still doing relatively well. I'm waiting for that turnaround. I don't see it right now, but deep down, I know it's going to happen because history tells us when people wake up and say, hey, I need yield, that's what I'm going forward, you're going to see that turnaround. But we don't see it yet. We just don't see it yet.
Okay. I don't want to get into the whole value versus growth thing because I have my own thoughts about that. But I want to go back to his point on ESG, which is very true, which is distinguish between a momentum play where all of a sudden ESG does better because people are putting money into it and actual fundamental outperformance, and don't confuse one with the other. That's a very good point that Professor makes. Will it attract more assets, and will we get that? Will suddenly ESG become a momentum play?
Potentially, and I think what's interesting, the ESG conversation we have with all the financial advisors we talk to across the country, it's that next generation, Bob, it's those millennials. They want to be invested in ESG. We don't know the structure, it's very loose right now, but they want to be invested. So I think it is going to continue to grow exponentially over the next 5 to 10 years.
All right. Final thought?
We're going to hear more from WisdomTree on this issue as well over time, also making sure we're factoring in valuations, quality ratios, things that broad multi-factor type incorporation.
Spoken like the senior investment advisor that you are. Thanks, guys. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Jeff, Jeremy, and Professor Siegel for joining us all today. And thank you for watching. You can find all of our latest videos, same spot right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a good weekend.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.